A devastating accident claim lands on an insurer's desk. The photos look real. The hospital bills look genuine. The witness statements seem perfect. Everything points toward a tragic, unforeseen event that deserves immediate compensation. But in the world of high-stakes insurance, things are rarely what they seem. What if the most tragic claim you've ever seen is actually the most calculated fraud? Welcome back to Corporate Secrets. Today we pull back the curtain on the multi-billion-dollar industry of manufactured misfortune. We are diving deep into the shadows where policyholders don't wait for tragedy to strike. They design it with surgical precision. From staged collisions to phantom surgeries, this is the anatomy of a betrayal that costs the global economy billions every single year. The modern insurance industry is under a level of pressure never seen before. Globally, claim volumes are skyrocketing, driven by an increasingly litigious society and a digital-first economy. Competition among insurers is fierce, forcing companies to prioritize faster claim settlements to keep customers happy and maintain their market share. This need for speed has led to a massive increase in digital claim approvals, where algorithms and automated systems often replace the seasoned eyes of human adjusters. While efficiency is the goal, this rapid-fire processing creates a dangerous blind spot. Fraudsters know that the faster a company tries to settle, the less likely they are to look at the fine print. It's a high-speed game of cat and mouse where the mouse is now using high-frequency trading tactics to bypass the traps. The very systems designed to help honest people are being turned into conduits for systemic abuse. What drives someone to cross the line from a law-abiding citizen to a professional fraudster? It often begins with the fraud triangle: pressure, opportunity, and rationalization. Some policyholders don't wait for misfortune to befall them. They manufacture it. In their minds, they aren't stealing. They are simply getting back what they've paid in premiums for years. They view the insurance company not as a safety net, but as a faceless corporate bank with bottomless pockets. This psychological shift allows them to plan elaborate schemes with cold, detached logic. They aren't just filing a claim. They are executing a business plan where the product is a lie and the profit is a tax-free settlement. This manufactured tragedy is a performance, carefully rehearsed and flawlessly delivered, designed to exploit the empathy and efficiency of the very systems meant to protect us. Perhaps the most dangerous form of insurance fraud is the staged accident. These aren't just minor fender benders. They are coordinated theatrical events involving multiple vehicles and scripted witnesses. The swoop and squat is a classic. One car pulls in front of a victim while another slams on the brakes, forcing a collision that looks like the victim's fault. Behind the scenes, these accidents are pre-planned down to the last detail, with vehicles often pre-damaged to maximize the payout. Witnesses are planted nearby, ready to give identical rehearsed statements to the police. The financial impact is staggering. In one major investigation, a single fraud ring was linked to dozens of staged collisions with a total loss exposure exceeding $1.8 million. This isn't just about the money. It puts innocent drivers at extreme physical risk for a payday. Once the accident is staged, the second phase of the fraud begins: the medical bill inflation. This often involves collusion with corrupt medical clinics or practitioners who are in on the take. Together, they create a paper trail of unnecessary treatments, diagnostic tests that were never performed, and phantom procedures that exist only on paper. A simple whiplash claim can be transformed into a series of expensive MRIs, physical therapy sessions, and specialist consultations that never happened. The goal is to maximize the special damages part of the claim, which increases the overall settlement value. This systemic billing abuse is a quiet drain on the entire healthcare system, driving up premiums for everyone else. When the hospital and the claimant work together to bilk the system, the complexity of the medical records makes it incredibly difficult for adjusters to untangle the truth from the fiction. Property damage claims offer another lucrative avenue for manipulation. Here, fraudsters often take a legitimate small incident and exaggerate it into a catastrophe. A minor kitchen fire might be presented as a total loss of all appliances and custom cabinetry. Alternatively, old pre-existing damage is presented as new. After a heavy storm, a homeowner might claim that a decade-old roof leak was caused by the recent wind. They use high-quality photos and professional-looking estimates to overwhelm the claims adjuster. In some cases, the damage is entirely manufactured. a burglary, where the stolen items were actually sold on the black market weeks prior, or a flood caused by a deliberately left open tap. The challenge for investigators is timing, proving exactly when the damage occurred and whether the cause was accidental or a calculated move to fund a home renovation at the insurer's expense. But perhaps the most chilling aspect of insurance fraud is when the call is coming from inside the house. Insider collusion occurs when claims officers, adjusters, or even underwriters are bribed by fraud rings to facilitate the crime. These employees know exactly how the detection systems work, and more importantly, how to bypass them. They can fast-track suspicious claims, override red flags, and ensure that payments are quietly executed without additional scrutiny. This inside knowledge is the ultimate key for organized crime groups. They don't have to worry about an audit if the auditor is on their payroll. As we uncover these layers, a haunting realization sets in. The fraud was not just a threat from the outside, it had already entered the very heart of the claims department. The trust that holds the industry together is the very thing being exploited from within. Individual fraudsters are a problem, but organized fraud rings are a crisis. These networks operate like sophisticated corporations, using multiple claims through linked or stolen identities. They might use runners to recruit people to participate in staged accidents, cappers to find corrupt doctors, and stuffed vehicles filled with passengers to maximize personal injury claims. They utilize a revolving door of aliases, P.O. boxes, and shell companies to keep their activities under the radar. By spreading their claims across different insurers and different regions, they avoid triggering the frequency red flags that might stop a lone operator. These rings are highly professional, often utilizing their own legal teams to threaten insurers with bad faith lawsuits if a claim is delayed. It is a high-volume, high-margin business where identity is the most valuable commodity. In the digital age, fraud has evolved. We are now seeing the rise of digital claim manipulation. Gone are the days of simple Photoshop edits. Today's fraudsters are using sophisticated AI tools to create deepfake injury evidence. They can generate videos of accidents that never happened or use AI to alter the severity of property damage in a photo. Metadata, the digital fingerprint of a file, is routinely rewritten to create fake GPS timestamps and dates, making it appear that a photo was taken at the scene of an accident when it was actually shot in a studio days later. This digital deception is incredibly difficult to detect with the naked eye. Insurers are now in a technological arms race, deploying their own AI forensics to scan every pixel of an incoming claim for signs of tampering. But as the tools of deception become more accessible, the barrier to entry for high-tech fraud continues to fall. Strategic timing is another hallmark of professional insurance fraud. This is often seen in policy abuse tactics, where coverage is purchased or significantly increased shortly before a staged event occurs. A fraudster might buy a high-value electronics floater on their homeowner's policy, only to report a total loss theft 2 weeks later. Or they might increase their personal injury protection limits just days before a planned car accident. These patterns are classic red flags, yet in the rush to onboard new customers, they are often overlooked by sales-focused departments. The fraudsters study the policy language as carefully as any lawyer, finding the optimization tactics that allow them to squeeze the maximum possible payout from every loophole. They aren't just breaking the rules, they are playing the game with a deck they've already stacked in their favor. The most frustrating part for many investigators is that the warning signals are almost always there. Repeated small suspicious claims might be overlooked because they fall below the investigation threshold. A claimant might have a history of 5 minor slips and falls over 3 years, each one settled quickly for a few $1,000s to avoid legal costs. These micro-frauds add up to millions in losses. The problem is that modern automation often overrides human intuition. When a system is tuned for speed, it might ignore the subtle patterns that an experienced human eye would catch instantly. The human element, the gut feeling that something doesn't add up, is being phased out in favor of algorithmic efficiency. But as we've seen, those very algorithms can be gamed, leaving the door wide open for those who know how to stay just below the radar. The turning point usually comes when the data finally speaks louder than the deception. Modern predictive analytics can now flag unusual patterns that span multiple years and multiple companies. Maybe it's a specific doctor whose name appears on too many high-value injury claims, or a car that has been involved in 3 total loss accidents with different owners. Once these triggers are pulled, the claims audit begins in earnest. Forensic accountants, digital investigators, and field adjusters descend on the case, re-interviewing witnesses and re-examining the physical evidence. This is the moment the fraudster fears, the moment their carefully constructed performance is subjected to the harsh light of professional scrutiny. The house of cards begins to wobble as the investigators start connecting the dots that the fraudsters thought they had successfully hidden in the digital noise. When a major fraud ring is finally exposed, the shockwaves ripple through the entire institution. Reserve losses increase, affecting the company's bottom line and shareholder value. Reinsurance partners, the insurers of the insurers, become tense, demanding more rigorous controls and higher premiums. Regulators step in, demanding explanations for why these patterns weren't caught sooner. It is a moment of reckoning that goes beyond the financial loss. It is a crisis of confidence. The ethical employees within the company are left wondering how such massive deception could happen under their noses. The cost of these scandals is ultimately passed down to you, the honest policyholder, in the form of higher premiums and more difficult claim processes. The institutional shock serves as a painful reminder that in the world of insurance, a single lie can have a multi-million-dollar price tag. So why does insurance fraud continue to grow silently? It's because the systems we've built to reward speed and efficiency also inadvertently reward those who know how to exploit them. It persists because ethical employees are often too busy or too fearful to speak up when they see a fast-track claim that doesn't feel right. And it thrives because, for many, insurance fraud is seen as a victimless crime, a way to take from a giant corporation that can afford it. But as we've seen, the victims are everywhere. From the innocent driver in a staged crash to every single person paying higher premiums. The lesson is deep and clear. Scrutiny is the price of integrity. As we continue to automate our world, we must never lose the human intuition that sees the person behind the paper. Because sometimes, the most tragic story is the one that was never true at all. If you want to understand how corporate fraud really happens and uncover the secrets they don't want you to know, like, share, comment, and subscribe to Corporate Secrets. Join our community of investigators as we expose the truth, one case at a time. Thanks for watching.